First of all, you're looking, are sales higher, are profits higher, are dividends higher? The really simple thing. Now, it's not entirely cut and dried. It is possible that sales have fallen, but it's still a good company to invest in. W.H. Smith, for example, has seen its sales fall quite consistently over many years, but the profits have gone up. So it's the profits that matter most, because you may find that a company is cutting out the loss-making stores, as in W.H. Smith's case. So it's not entirely controlled, but this is what you want. You want a company that is increasing its profits all the time, increasing its dividend all the time, and preferably increasing sales, but that's the least important. The bottom line is what matters to investors in the end. It's very important to my mind to look back over how a company has done over the past 5 years. Going back further than the 5 years isn't worthwhile because so much can change, but 5 years gives you a trend. So you can see our sales going up consistently, our profits going up consistently, is the dividend at least steady or going up consistently. Doesn't matter if somewhere within there's a bit of a blip, as long as the general trend is fine. I think those 5 years figures are vital to all long-term investors, and that's what you look for, and it's so easy to find. Now, one thing you're looking for is gearing. Now, if you don't understand gearing, what you're looking for is a percentage figure. It will be published by the company. It's a percentage figure. The higher the percentage, the greater the amount of debt there is for the size of the business. If you're a very big business, it doesn't matter if you've got a big debt. You may be quite small for the size of the business, whereas a little company can only afford a smaller debt. So it's not the size of the debt so much, it's the gearing, is what sort of percentage it is. And for most companies, the lower the gearing, the better. And you're looking for the gearing to be falling. The PE ratio is an indication of how expensive a company is. On the whole, the PE ratio in London Stock Exchange is usually round about 13 or 14. What it means is you're dividing the price per share by the earnings per share. And it gives you some idea of whether the company is expensive. So if the PE is 13, at the current rate of earnings, it will take 13 years for those earnings to reach the share price. That's what it's saying. If you don't understand the complication, don't worry too much about it. Anything less than 13, you're thinking the shares look cheap. Anything above 14, you think the shares look expensive. Yield, like PE, is one of the two ratios that shareholders should look for. If you don't understand any other ratio, and some are very complicated, try to at least understand PE and yield. Now, with PE, the lower the figure, the cheaper the shares look. With yield, you're trying to find a higher figure, because what yield is, it's a percentage. For every £100 you invest in the company, what is it paying you back in dividends? Now, the yield on the London Stock Exchange tends to be about 3.5%. In other words, for every £100 you invest, you get back £3.50 per year, which is far better than you'll do in a bank or building society. The higher the figure, then the more money you're getting back. So normally you'd look for something with a higher yield. But again, there's always the warning. Once you get up to about 6%, you should start being very cautious, because the higher the yield you promise, the more likely it is that you'll fail to get it. The management statement is important because it gives you some clue of how the management is thinking, but don't get bogged down with the management statement at the top. remember that the board of directors is only human. They will always try to put the best gloss on the situation they can. It's very rare for a company to be so honest they put up bad news up at the top. So you're getting all the best news at the top. You must work down the statement and read through it and see if there's something hidden away. And in particular, go down to the bottom where you'll normally find the headline Outlook, and you must always read the Outlook statement, because that tells you what the company thinks is coming up. But also, you're looking, sometimes you get quite a glowing statement, and halfway down, buried away, you see profits will fall short this year. And it's hidden. So you do have to read through the statement. So what the management's saying is important, but you do need to read all of what the management is saying.